This is part two of the market maker sell model discussing the sell side delivery on the right side of the curve. So from our last lesson, we have already discussed about the different ways we can grade deviations and how we can arrive at a calibrated terminus. Now let's get into a little bit more detail about the sell side delivery within the sell program. So we have already had our smart money reversal here. We had our manipulation leg, which ran the stops above our short-term swing high. We have keyed off a higher time frame level, and this has completed our buy program as we have reached terminus, so the buy side of the curve of a market maker sell model. We have witnessed a change in state of delivery running through the opening price of a bearish order block, confirmed with displacement, and our sell program has now been initiated. So in the upper area, after our change in state of delivery, we have our first entry, which is going to be our low risk sell. And this is going to occur after the change in state of delivery has been confirmed. Now, time is going to play a crucial role in this. The change in state of delivery will be confirmed with displacement and time, but we will get into the topic of time at a later lesson. So this is what our change in state of delivery would look like, where the buy program has completed its buy side delivery, and we have rejected the higher time frame level and run below the opening price of the last up close candle, which becomes our bearish order block. Now, the low risk sell will be a retracement back into the order block, and then we would see a move lower as the sell side program continues. On a lower time frame, you will see a fair value gap inside of this order block. This will be a high probability fair value gap. It doesn't need to come in to rebalance that. It can often just key off the low to the opening price and run lower, leaving that fair value gap open. We can travel higher into the order block, but we do not want to see the mean threshold of the order block breached on a closing basis. We next have our break-in market structure, where we've had a run on the sell side liquidity below the second stage of accumulation. This gives us our break-in market structure. Again, we do not need to close below the low in order to have a valid break-in structure. On a side note, if we break below the second or final stage of reaccumulation, this is much more significant than a smaller break inside of the manipulation swing that run stops. Often, traders will be far too zoomed in on a lower time frame, and they're looking at the lows, and every low that gets broken, they're considering it as a valid break-in structure. You need to zoom out and look at where you are inside of the different stages of reaccumulation. The highest probability valid structure break is going to be the second stage or the final stage of reaccumulation. Again, the fair value gap found inside of the expansion leg that broke structure is going to give confirmation of the valid structure break. In this area, we will have our first stage of distribution, where we return to the fair value gap inside of the leg that broke structure, and we will mitigate at the breaker, which is the down close candles that rests inside of the final stage of accumulation. We then have a second structure break and then a continuation lower to seek the next sell side liquidity below the first stage of accumulation. After we have run the sell side liquidity below the first stage of accumulation, we will begin our second stage of redistribution on the right side of the market maker sell model within our sell program. We will run the sell side liquidity below the first stage of accumulation. And again, as a side note, there can be more than two stages of accumulation or distribution cycles. It all depends on what price is presenting at the time and what we can see on our charts. We again have a break in market structure. We return back up into a fair value gap, or we witness a run on stops above a short-term high, and then we mitigate inside of a distribution block. The distribution block will be the down close candles inside of this stage of accumulation. In this example, this is the first stage of accumulation. But like I said, you can have many different stages of accumulation, but the concept remains the same. We then continue lower to seek the next stage of sell side liquidity below the initial consolidation and ultimately to our calibrated terminus. The distribution cycle essentially consists of these four things. We run liquidity, we rebalance or we run stops, we mitigate within an area on the left side of the curve, and then we continue lower to seek liquidity. Knowing just this alone will serve you very well going forward. Essentially, this is the mechanics of how the distribution cycles work. Like always, reverse this for the buy side of the market maker buy model. Again, your homework is to go through your own charts and try to find an example of this in a market maker buy model. Thank you for watching, and I hope you found this insightful, and I will catch you again in the next lesson.